Welcome to another episode of the Brave Money Podcast. This is your host, Leon Gabon. And with me today, I have a dear friend, Daria Woods, former coworker at the startup we worked at, TickerTags, founded by Chris Camillo. She's now a finance and healthcare consultant. Hey, Daria, how's it going?
Good. Hey, Leon, how are you?
Doing good, doing good. I wanted you to bring you on the show because I wanted to talk about tax avoidance and that lunch we had the other day. There were so many ideas, and this podcast is about getting these ideas to regular people. Like, hey, these are things you can start doing to benefit yourself financially. So with tax avoidance first, that word kind of sounds scary, but you
Right.
told me that's like the legal word for it, right?
Yeah. So it definitely does sound scary because we all know that tax evasion is illegal. So we're not talking about tax evasion, but tax avoidance is actually, the industry term for trying to pay the least amount of legal tax. So to limit your tax liability. And that's done through both estate planning and then also through tax planning with like a CPA. So first off, I want to just say that, this is all just this information that I've kind of gathered throughout talking to different people, doing my own research, but I am not a CPA in any way. I'm not a registered investment advisor, not an attorney. So, people can listen to this and glean what they may, but please consult, the appropriate professionals or do your own research before making any actions.
Exactly. For most investors and traders, I believe we all know about the simple one, which is long term versus short term capital gains tax. So,
Hmm.
meaning if you buy a stock or crypto now, if you hold it for longer than a year, and you sell after that year, you get hit with less taxes than if you sold within 6 months. So, I
Yep.
believe the difference right now is 15% for long term and 20% for short term capital gains, but that can change with Biden or someone else. But that's a basic way of like um, tax avoidance.
Yeah,
Uh,
so one thing to note about short-term capital gains is it's actually taxed at whatever your ordinary income tax bracket is. So it could be 20% if that's what your income tax bracket is, but it could be higher or lower depending on what your income tax bracket is.
gotcha. Yeah, good point there. Another way of tax avoidance, and this is probably for higher net worth people, but people who do charities, right? There's this thing with donating cash versus donating stocks.
Yeah, so if you donate to a 501c3, which is a charitable organization by the IRS, you can take that as a tax deduction when filing your taxes. So, this is something that I've been considering recently because certain types of investment accounts, retirement accounts, are limited to what your income is. So if you make over a certain amount of dollars in a year, then you actually are not eligible to invest in those accounts. So one way to make your income lower is by donating to charitable organizations or 501c3s. What we were talking about the other day is, like I feel like it's becoming more and more common in our culture that people tend to have causes that they really care about and are really passionate about. And so one thing that you can actually do is if you yourself want to start a charitable organization and set up a 501c3, then you can actually, now obviously, there are rules around what you can do as a 501c3. So obviously we're not trying to tell people to make fake charitable, organizations, but if there's something that you really care about, then you can create your own 501c3. You can donate your personal income to fund the 501c3, take a tax deduction from your personal income, and then use, the 501c3 money to do charitable work that you actually care about, and you'll know exactly how all of the dollars were spent.
Mm-mm. And also with some of these charities, or maybe with a 501c, is there a way where you can kind of pay yourself as since you're kind of like managing the charity? in that way? And would that be
You
tax free?
can, yeah. So 501c3s, charitable organizations, they are allowed to have a staff and you are allowed to take a salary from that. However, that salary that you would take out of your 501c3, that would be taxable, right? So
Mm,
if let's just use round numbers, like let's say that you donated $10,000 to a 501c3 and then you took $1,000 as income from that, well, then you would only be able to deduct $9,000 from your personal income tax, right? Because you donated 10, but then paid yourself one.
gotcha. Cool. Um, awesome. And okay, self-directed IRAs is that another thing we can save money or of tax avoid taxes?
Yeah, so I think a lot of people know about 401ks mostly through their employers, although a lot more people are becoming familiar with IRAs, which is individual retirement accounts. So for both IRAs and 401ks, there are two kinds, and they both have different tax implications. The first is a traditional, and what a traditional IRA and a traditional 401k does is that you are allowed to deduct any contributions from your current tax year. But what we've been talking about is with a Roth IRA or a Roth 401k, what that means is that you pay taxes up front, but you take it out tax-free when you're 59 and a half. So there are, pros and cons to either one, depending on what your objectives are. And also there's a little bit of guesswork in whether or not you think that your income tax bracket will be higher now versus when you retire, or vice versa. And then the other thing to be aware of is that 401ks generally are very limited in what they can invest in. So it's generally mutual funds or indexes, whereas IRAs are extremely flexible. So what you can do is you can get a self-directed IRA, either Roth or traditional, and you can invest in almost anything. There are a few limitations in the sense that it has to be an investment. So for example, your personal home, you can't use your IRA money to buy that because the IRS doesn't consider that an investment, but you could use your IRA contributions to buy a rental home.
Mm. Oh yeah, and in a rental home you can make income on it, and
Yep,
though that
absolutely.
income would be taxable.
Mhm.
Cool. And there was a major piece we talked a lot about, which was life insurance. I'm sure there's a
Yes.
ton of stuff we can get into there.
Yeah, so life insurance, I think, is one of those things that a lot of people don't recognize how it can be used as a financial tool. They think of it like car insurance, right? So if something happens to you, then you get in a car accident, your car insurance will cover up to a certain amount, right? And so a lot of people think of life insurance the same way, that if you pass away, then your beneficiaries will be covered to whatever policy you've paid for. But there are actually a bunch of cool things that you can do with life insurance as an investment. So one of the common ones is annuities, but the one that I'm personally more interested in is getting a cash value whole life coverage. And what you can do with that is you can basically overfund your cash value. And the great thing about life insurance is when you're talking about like long-term estate planning and long-term tax avoidance, anything that is paid out as a death benefit from a life insurance policy is tax-free to your heirs. There is one limitation that I'm aware of. It's that if your heir is a minor and for some reason you set up your insurance policy to where it doesn't give them the full amount of your coverage, it gets put into a trust until they turn a certain age, then they would have to pay tax on the interest earned while it was in trust. But if it's paid directly to your beneficiaries, then there's no tax liability for that. So it's really great when you talk about like multi-generational wealth preservation and then multi-generational tax avoidance, because I think a lot of us, we're focused on maximizing our gains now and avoiding taxes now. And we don't really realize that, if we don't do estate planning, then Uncle Sam is going to take a significant portion of your estate, and that's not going to go to your heirs.
Yeah, very interesting. So, and we can borrow money through that life insurance, right? For different
Yeah,
things.
so it's really interesting when you get a whole life plan with a cash value. What you can do is a couple of different things. So, one, you can borrow a traditional loan from a traditional bank using your death benefit as collateral. So, let's say you personally don't have that much assets that a bank would consider for collateral, but you have a life insurance policy that is whole life and the death benefit is $1 million. Well, the bank can use that death benefit as collateral to underwrite a loan, and then you can do whatever you would normally do with that traditional bank loan. So you could buy your own personal house, right? Which you probably wouldn't, because you would just get a mortgage for that. But you can do different things, because it's not restricted like in IRA. So you could write yourself a small business loan. Another thing that you can do is that you can borrow against the cash value in the policy, not the death benefit. So the death benefit would remain the same, but there you can borrow against the cash value of the policy. And again, like this is, so it's a little bit hard to go into particulars here because it's really going to depend on how your policy is specifically written, which will depend, on your age, on the health conditions that you have when you get the policy, what company you go through. Each insurance company is a little bit different, but most insurance companies that offer whole life will be familiar with these types of strategies for, both wealth preservation in a multidimensional, generational sense, and also they'll understand, what you're talking about when you're talking about, borrowing against the policy.
Gotcha. Yeah, so I have a question that's trader related. So with these life insurance policies, are there any that are self-directed? Like, can I go in and say I want to use this cash to buy Tesla shares in this life insurance, or
So
does it work that way?
So yes, but not through the policy. So how you would do it is you so when your policy is written there, it's kind of like a mortgage in that you set a term for it, right? Not in the term of coverage. So like if a lot of people have a 15-year term, which means that if they die within the next 15 years, they will get their beneficiaries will get the death benefit. But a term in the sense that whole life policies are generally structured that you pay into the policy for 15 years or 30 years. And then after that, you don't pay premiums anymore. What they do is your account has a cash value throughout the lifetime of that policy, and that cash value earns interest, because the insurance company invests in the stock market, right? Or they have various different investments. So again, it'll depend on what specific insurance policy that you have, but most of them will quote about 4.5%, 4%, is how much interest the policy will accumulate, every year. So what you can do is from that cash value, you can't within the policy directly buy Tesla stock, but you could take out the cash value and then, buy Tesla stock or buy whatever investment that you wanted with that. So generally, the larger the policy, obviously, the larger the cash value that you'll accumulate over time. So, some of my parents' friends have used their life insurance cash value to, buy medical equipment for a medical practice that they own, or buy a house, or do all kinds of different things that you just ordinarily wouldn't get to do with different types of protected income. Generally, if you're going to buy stocks, could you use your life insurance money? Sure. But I would argue that it's probably better to use your IRA money, just because when you take out the cash value, there can be income tax implications to taking it out.
Gotcha. Yeah, I was just curious if there's a way that, okay, I'm giving you guys cash. I don't know you guys are investing in the stock market. I think you guys should invest it over here. So
No, unfortunately, yeah, you
gotcha.
can't do that. It's all indexed, right? And the reason that is because if you know anything about insurance companies and actuaries, they're all about, massive, massive spreadsheets with all kinds of different statistics, right? And so
Mhm.
they have their own risk management situations. Obviously, they know that they're not going to get the top of the top in terms of gains, but their entire strategy is preservation because,
Yeah.
ultimately they have to be able to pay out death benefits.
Mhm.
And so they want to grow, but safely grow because they need to have cash. Now, one thing that is nice about life insurance in the United States, at least, is there has never, ever been a death benefit that was not paid out. So, in a multi-generational sense, you can have security in knowing that your beneficiaries will get the full dollar amount,
Mhm.
obviously, so long as you pay your premiums and your policy doesn't lapse.
Yeah. Yeah. Cool. Who would you recommend, I guess, for life insurance, or who are you looking at, or yeah?
Yeah, so I actually just got a policy from Northwestern Mutual. Um, I have a great, great girl here in Dallas that I've been working with. We actually have kind of become friends through this whole process and had brunch last
Oh,
weekend.
nice.
But yeah, she was very familiar with what I'm trying to do with the policy, and was able to answer all of these questions specifically related to the dollar amounts that I was interested in, the time frame that I was interested in. So what I actually did is I got a $500,000 whole life policy now, and then I bought an additional $5.5 million term to 80 policy. So what that means is that I personally view it like an option. Basically, that policy is that if I die before the age of 80, it will just pay out the normal death benefit of $5.5 million to my beneficiaries. But how I view it as an option is that I have the option to convert that to a whole life policy, either in whole or in part,
Hmm.
until the age of 60. And the reason why I chose to do that is because, for me at least, I didn't want to put so much capital into paying premiums for a whole life policy now. Term policies by far have lower premiums than whole life policies.
Hmm.
So, I just am not at the stage where I want to put all of my money into like a safe investment. I want to be more risky with my investing money. And so I'm keeping
Hmm.
that in my investing accounts for now. And then gradually I will, choose to exercise the option, right, to
Hmm.
convert to whole life down the road.
Yeah, that makes sense because at 59, I mean, we most likely way better off than, I mean, capitalized.
Yeah, and
Yeah.
so the
So.
reason why like I decided to get such a large portion as term to 80 now is because at different points in your life, like I said, insurance companies and actuaries, they're all about statistics. You might not be able to qualify for larger policies the older that you get and if your health conditions change.
Mm,
So in
good point.
general, with life insurance, you want to start younger and you want to start when you're healthier, because premiums are going to be lower and you're also going to qualify for a lot more. Now, the
Mm,
only mitigating factor is that if you want a very large policy, like into the millions of dollars, then if you are not married, if you do not have children, then the insurance company is going to want to know why you want such a large dollar amount of coverage. And so generally, that's going to be income based. There's not really a
mhm.
hard and fast rule of like they will insure up to 5 times your income or something like that. Um, it's really going to depend on what you're asking for, but there's going to be a lot more income verification to see why you want a large dollar amount.
Gotcha, gotcha.
Yeah.
Yeah, excellent, and definitely makes sense. And I hope we've convinced a few listeners to look at some life insurance now.
Yeah, it's definitely interesting, and I think it's one of those that's a little bit overlooked, but it can absolutely give you access to a lot larger scale of capital without having to be an accredited investor. So I think as we've talked about, like a lot of the ways where you can grow your money really quickly, you know, for right or for wrong, I personally dislike it, but it's reserved for accredited investors, right? So
Mhm.
yeah, if you make a great call on a stock like Tesla, then you can grow your money really fast in the stock market, which is open to anyone. But a lot of those high growth opportunities are limited to accredited investors, whereas life insurance is
Mhm.
not. And so you can give yourself access to capital by borrowing against your death benefit, that you might not have been able to get access to before.
Gotcha. Makes sense. Cool. So is there anything new out there you're kind of like researching into tax avoidance or things are coming up? I know there's some stuff in real estate, but we can put that on a different show. But yeah, any thoughts
Yeah,
there?
so I think one thing that again, it's going to be different for everybody's situation. And it's also going to be different if you're thinking short term or long term. So for like longer term, when you're talking about passing on wealth, one thing that's really important, I think, is getting a revocable living trust. So that's something that you can set up now. It's only a couple $100. And basically, what that means is that it will protect your money, and you can be very, very specific on how you want it to be used after you pass on, to used either by like maybe family members, or maybe by organizations, or maybe if you want to set up like a scholarship fund, or whatever it is, you can set that up in a revocable living trust. You can also change your mind, right, because it's revocable. So if you're family member really ticks you off and you don't want to leave them anything, well, then you can change it, right?
Mm,
Or if you get a second marriage and you have a second family, well, then you can change it, right? It's not locked into what you originally
mm,
set it up as. And now I think trusts, a lot of people associate them with like high net worth individuals, and they absolutely are beneficial for high net worth individuals. But I think when it comes down to the controls of how you want your money to be used, they can really be useful for anyone, right?
mm,
So if you want to be very specific on how your beneficiaries use your money after you're gone, maybe you're concerned that you don't want them to do something that you think would be squandering the money or something like that, then you can set very specific terms in that trust.
mm,
Um, Now, another way, if you don't want to do that, but you want to pass on money, while trying to minimize tax liability, is that, and again, it's going to depend on how much you trust people, is you can actually add co-signers um, to your bank accounts, right? So maybe you have one child, or you don't have any children, but you already know who your spouse, people do this in marriage all the time, right? That if one spouse passes away, then the other spouse is a joint owner of the account. And so the money just passes seamlessly to them. It doesn't have to go through escrow, which is like a huge, huge benefit to the surviving people. But then also, if the person is a co-owner, a joint owner of the account, then they have less tax liability. So I forget the dollar amount off the top of my head, but I want to say if it's less than like $500,000, or maybe even $1 million, but it's a relatively high number. If it's less than that dollar amount, then the co-owner doesn't have any tax liability on it. It's only the amount in excess of that. But keep in mind that as soon as you make someone a co-owner, a joint account holder, then they have full access to the funds. And so this is why, I think it really depends on your situation, because they could, as soon as you make them the joint account holder, take all the money and leave, and you would have no recourse to get that money back.
mm, mm. Gotcha. Yeah, some good points there.
Yeah.
Um, cool. Yeah, I guess that's all my questions at the moment. I think we covered a ton. Yeah, we. I didn't re-listen to the life insurance part myself. Um, there is a strategy I'll bring up that I'm thinking of planning for myself, which is with crypto specifically.
Yep.
I guess this has worked with dividends with Warren Buffett and whatnot, but basically, you can own these different coins, and not sell them, not rip that capital gains tax, and just earn either interest on it
Yep.
or staking rewards, which do count as income. But again, at least you're getting income basically, as long as the coin is alive, you know, and not reaping huge capital gains tax and selling
Okay,
coins.
yeah. So that sounds a little bit to me like a 1031, um, like in real estate, right? Because in
Mm.
real estate, there are certain rules that so long as you reinvest the proceeds from the sale of real estate within a certain time period, in certain parameters, then that's not taxed. Now, ultimately, it will be taxed at the very, very end when you officially take your gains instead of reinvesting. But yeah, those are always like very interesting policies.
Yeah. Okay. So you brought it up. So I guess we're not saving it for a different show, but we'll talk about it really quickly. But yeah, real estate. So what was that again?
A
1039?
1031?
1031. Yeah.
Yeah.
So I heard this from some other people who are investing in real estate, and
Hmm.
yeah, how they explained it to me was they just buy houses, they get renters, and they do sell the house, but then like you said, reinvest it
Yeah.
in another house, and they keep pushing that off, and they keep doing that forever and ever, and they don't ever pay taxes on it, and then you just
Yes.
pass
Yeah.
that down to your
Mhm.
kids
Right.
or
So
whoever. Yeah.
so there definitely are a lot of families that do that, right? And it's generational. It gets passed on because it's exactly right. So the rental income you would be paying tax on, but the sale of the underlying asset, the real estate, that would not be taxed so long as you reinvest that in another property. Now, if you get to the point that you sell and you don't reinvest within the parameters of the 1031, then that's when you would have a tax liability.
Yeah, and I guess on all sales or just that last one. I assume all
Well, it,
sales.
it would just it would just be on the last one, but it's based on the
The
basis
gains
of
from,
the
yeah,
first one. Yeah.
yeah, yeah. Gotcha,
Mhm.
gotcha. Yeah, so that's a really exciting thing I've just learned about recently in real estate. Like, oh, okay, maybe I should get into houses later.
Yeah, it's very interesting. There's all kinds of fun stuff. And the one thing that as far as I'm aware, that's equalizing about the 1031 is that anyone can do it. I don't believe there's
Mm.
any restrictions on who can use that like reinvestment 1031.
Yeah, very cool, very cool.
Hmm.
Um, well, thanks for spending time with me today, Daria, and to everyone else. Yeah, may the stunk gods be with us.